There's a debate that's been raging in the investment world for decades. Dividend stocks or growth stocks? Which one makes you richer? And the answer that Wall Street gives you is wrong. Because the answer isn't about which is better. It's about which is better for you. Your age, your situation, your goals. The framework Wall Street won't tell you is that the right answer depends on where you are in life. And once you understand this framework, you'll know exactly which strategy to use. Some people swear by dividends, steady income, predictable cash flow, peace of mind. Other people swear by growth, explosive returns, wealth compounding, life-changing gains. But here's the thing, both are right, and both are wrong. It depends on your situation. If you're young, growth stocks are your best bet. If you're old, dividend stocks are your best bet. If you're in the middle, you need both. And if you understand this framework, you'll make better investment decisions for the rest of your life. If this interests you, leave a like and comment which strategy you're currently using, because the answer will tell you if you're positioned correctly for your age and goals.
Let's start with dividend stocks. A dividend stock is a company that pays shareholders a portion of its profits, usually quarterly, sometimes monthly, sometimes annually. The yield is typically 2 to 5% per year. So if you own a dividend stock yielding 4% and you invest $10,000, you get $400 per year in dividend payments. That's cash in your account, without selling a single share. This is why retirees love dividend stocks. You need income to live on. Dividend stocks provide that income, without forcing you to sell your capital. If you sold shares instead, you'd be depleting your principal. Eventually, you'd run out of money. But with dividends, you can live off the income indefinitely. The company keeps paying dividends. You keep receiving income. Your principal stays intact. Dividend stocks are also typically less volatile than growth stocks. Companies that pay dividends are usually mature, stable businesses. Utilities, consumer staples, financial services. These aren't sexy companies. They're not going to 10 times. But they're stable. They pay dividends. And they don't crash 50% in a bear market. The downside is limited. The upside is also limited. But the income is consistent. And for many people, that's exactly what they need.
Here's where something magical happens, and most people completely miss this. It's called dividend reinvestment, or DRIP. Every time you receive a dividend payment, you automatically use it to buy more shares. Those new shares generate more dividends, which buy more shares, which generate more dividends. It's a compounding snowball effect. Let's run the numbers. Invest $10,000 in a dividend stock yielding 4% annually. After 30 years with dividend reinvestment and modest stock price appreciation, that $10,000 becomes over $80,000. Without reinvesting, only about $45,000. The difference is massive, and it gets even better. The longer you hold, the more powerful the compounding becomes. Year 1, you earn $400 in dividends. Year 2, you earn $416. Year 3, you earn $433. The dividend payments are growing because you have more shares. And more shares means more dividends. It's a self-reinforcing cycle. This is why Warren Buffett loves dividend stocks. He's been reinvesting dividends for 60 years, and that compounding has turned billions into hundreds of billions. DRIP is the secret weapon of dividend investing. Most people don't use it. They take the dividend payment and spend it. But if you reinvest it, you're creating a compounding machine.
Growth stocks are different. Growth stocks are companies that reinvest all their profits back into expansion. No dividends, zero cash payments to shareholders. Instead, they focus on one thing: growing as fast as possible. These companies are building new products, entering new markets, acquiring competitors, scaling aggressively. They believe every dollar reinvested in the business will create more value than giving it to shareholders. And when it works, the stock price explodes. Tesla went from $30 per share in 2020 to over $400 at its peak. That's a 1,200% gain. Nvidia went from under $100 in 2019 to over $1,000 in 2024. That's a 900% gain. Amazon has never paid a dividend ever. Yet if you bought Amazon stock 20 years ago, you'd be up over 20,000%. These aren't dividend payers. These are wealth compounding machines. Growth stocks typically trade at high price-to-earnings ratios, sometimes 50 times earnings, sometimes 100 times earnings. Sometimes they're not even profitable yet. Why? because investors are betting on future growth, not current profits. They're saying, this company is going to be massive in 10 years. And if they're right, the stock price reflects that future value today. But here's the catch. Growth stocks are volatile, really volatile. In a bull market, they soar. In a bear market, they crash hard. Tesla dropped 70% from peak to trough in 2022. Amazon fell 50%. Nvidia dropped 60% before recovering. If you panic and sell during the crash, you lock in massive losses. Growth investing requires strong conviction and the ability to hold through brutal drawdowns. This is where most people fail. They buy a growth stock at $100. It soars to $200. They feel like geniuses. Then it crashes to $80. They panic. They sell. They lock in a loss. And they miss the recovery to $300. This happens over and over again. And it's why most people don't get rich from growth stocks. Not because growth stocks don't work, but because they can't handle the volatility. They don't have the psychological fortitude to hold through the crashes. But if you can hold through the crashes, the returns are staggering. A 15% annual return doubles your money every 5 years. A 20% annual return doubles your money every 3.5 years. Growth stocks give you the potential for those 20% plus returns. But you have to be able to stomach the volatility. Here's the framework Wall Street won't tell you. If you're young, in your 20s or 30s, with decades until retirement, growth stocks are likely your best bet. Why? Time. You can ride out volatility. Market crashes don't matter when you have 30 years to recover. And the compounding effect of high growth rates over decades is absolutely staggering. If you're in your 40s or 50s, a balanced approach makes sense. Maybe 70% growth stocks, 30% dividend stocks. You still want growth, but you're starting to think about income stability. You're starting to think about what happens if the market crashes in 5 years. If you're approaching retirement or already retired, dividend stocks become crucial. Because you need income, not just growth. Selling shares to fund your lifestyle means you're depleting your principal. But dividend income, that's cash flow without touching your capital. You can live off dividends indefinitely. This framework is simple, but it's powerful because it acknowledges that your investment strategy should change as you age. A 25-year-old and a 65-year-old should not have the same portfolio. They have different needs, different time horizons, different risk tolerances.
Let's compare two investors with the same starting capital and two very different outcomes. Investor A, growth strategy. $50,000 in NASDAQ growth stocks. 15% per year for 20 years. Final result, over $800,000. Sounds great, but there's no cash flow. To spend money, shares must be sold, and taxes are paid. Now, Investor B, dividend strategy. Same $50,000 in dividend aristocrats. Lower returns, but steady income. After 20 years, $636,000. Less total value, but over $25,000 per year in passive income. No selling, no stress. And here's the bonus. Qualified dividends and long-term gains are often taxed at lower rates. So the real difference isn't how much you have, it's how you live off it. Investor A has more money, but Investor A has to sell shares to spend it. Investor B has less money, but Investor B can live off the income indefinitely. Which is better? It depends on your situation. If you're still working and don't need the money, Investor A is better. If you're retired and need income, Investor B is better.
The smartest move is to combine both strategies. Allocate based on your age and goals. Younger investors tilt toward growth. Older investors tilt toward dividends. Most people in the middle should own both. You get growth potential and passive income. Best of both worlds. Here's how to structure it. If you're in your 20s or 30s, 90% growth, 10% dividend. You want maximum growth potential. If you're in your 40s or 50s, 70% growth, 30% dividend. You want growth, but you're starting to think about income. If you're in your 60s or approaching retirement, 50% growth, 50% dividend. You want income, but you still want some growth to keep up with inflation. If you're retired, 30% growth, 70% dividend. You want income, but you still want some growth to preserve purchasing power. This framework gives you the best of both worlds. You get the explosive growth potential of growth stocks when you're young and can afford volatility. And you get the steady income of dividend stocks when you're older and need cash flow. Let's recap fast. Dividend stocks are stable, income-generating, lower volatility, perfect for retirees or conservative investors. Growth stocks are high-potential returns, high volatility, ideal for long-time horizons and aggressive wealth building. The right choice depends on your age, risk tolerance, and financial goals. If you're building wealth, growth wins. If you're preserving wealth and generating income, dividends win. If you're smart, you own both. Now you know exactly how to structure your portfolio based on your situation. If you found this breakdown valuable and you want to learn how to build a portfolio that works for your life stage, subscribe to Mac Invests. We break down investment strategies and how to apply them to your life. New videos every week. Each one gets you one step closer to financial freedom. If this video helped you, leave a like and comment which strategy you're currently using. Because the right answer depends on your situation. And now you know exactly what that situation is.